Decoding valuation of unquoted shares under Rule 11 UA 1 small c small b. I am sure, friends, many of you would have come across a situation because, as practicing company secretaries or also as company secretary in employment, we come across many situations where the shares of unquoted entities are to be transferred, and therefore these shares are to be valued. How do we do the valuation, or how these unquoted shares of private limited companies or unlisted companies are valued as per the Income Tax Act? So Rule 11 UA1 CB talks about the valuation of such unquoted shares or shares of unlisted companies. Now, for this purpose, we need to ask a question to ourselves and answer that question. What the question is? The question is, what is the philosophy and objective of the department behind Rule 11 UA 1 small c small b for determination of fair market value of unquoted shares? So the question is, why you think the Income Tax Department has brought Rule 11 UA 1 small c small b? And the answer, of course, is very simple. And the answer is that it is possible that some people can misuse the provisions and thereby they try and evade the tax. And that is what the department does not want to happen. So department does not want that people should resort to the things, to the tactics that would result into evasion of tax. So the answer to this question is, what the department wants is assets should not be overstated and liabilities should not be, assets should not be understated and liabilities should not be overstated. Thereby the fair market value should be maximum so as to have maximum capital gain and thereby to have maximum tax. So that is what is the purpose and the objective as far as the department is concerned. So what should be, what the assessee should not do? Assessee should not understate the asset. So when the assessee is selling an asset, right, and for which the capital gain is to be determined, if the unquoted share or the company whose unquoted shares are to be valued, in the process of the valuation, if the assets are understated, liabilities are overstated, what is going to happen? The consideration, the valuation of this unquoted share is going to be understated. If the valuation of these shares is understated, that means what? That means there is going to be lesser amount of capital gain. And if there is a lesser amount of capital gain, what would it mean? It would mean that the department is going to collect lesser revenue on account of capital gains tax. So this is the philosophy and the objective and the purpose behind this particular Rule 11 UA 1 small c small b. So when we keep this understanding in view, our understanding of Rule 11 UA 1 small c small b becomes very simple and easy to understand. So what this Rule 11 UA 1 small c small b is for determination of fair market value of unquoted equity shares. So what this rule tells, this Rule 11 UA 1 small c small b, for the purpose of determination of fair market value, it gives a formula, and the formula is A plus B plus C plus D into P divided by PE. So what this formula is, what A in this formula is A in this formula is all the assets of the entity, all the assets of the entity other than B, C, and D. So we understand what is A. A is all the assets of the entity as given in the balance sheet of the unquoted company. All the assets of the unquoted company given in the balance sheet, plus other than B, C, and D. What is B? B is jewelry. B is archaeological work, archaeological objects. B is painting. B is other artistic work. So that is what is B. C, what is C? C is value of unquoted shares. Value of unquoted shares. And what is D? D is immovable assets. Immovable assets. And what is L? L is the liability. L is the liability. So I'm sure you would have understood. So what you're trying to do, you're trying to find out the value of unquoted shares. So for determining value of unquoted shares, what you have to do, you have to follow this formula: A plus B plus C plus D. A would mean all the assets given in the balance sheet other than B, C, and D. B would mean the jewelry, archaeological objects, or artistic work or painting. C would mean unquoted shares, and D would mean the immovable assets, minus L. L would mean the liabilities. PV is the number of shares which are to be valued, and PE is the total number of shares. In other words, you can also understand it this way: PV is the value, the face value of the shares which are to be valued, and PE is the paid up capital, total paid up capital of the company. This is how also you can understand. Now the question is, who can do the valuation? As per Rule 11 UA1CB. So remember, it is based on the balance sheet. So this valuation that we are trying to find out is based on the balance sheet. Hence, external report not necessary, but still recommended by an income tax registered valuer to ensure formula compliance. So whenever you are doing valuation, as per Rule 11 UA1CB, remember this valuation is based on the balance sheet. So therefore, theoretically speaking, you only have to pick up the number from the balance sheet and do the valuation. But you also need to remember, and what you need to remember is that there are jewelries, there are land and building, there are immovable properties, and those will need to be valued. And for that, you will need to obtain valuation from some external agency. Now we need to break and understand this formula further. So what is A? Book value of all assets other than jewelry, artistic work, shares, securities, and immovable property in the balance sheet as reduced by. So I'm sure you would follow it very clearly. So all the assets which are given in the balance sheet, pick up all those assets except jewelry, artistic work, shares, securities, and immovable properties, because these are to be valued separately, and that is why you have to keep them aside for the time being. Reduced by the any amount of income tax paid or advance tax. So in case if you have paid advance tax which is higher than your tax liability, so the excess amount of the tax that you have paid as advance tax, or which has been deducted as TDS or TCS, that has to be reduced. Any amount shown as asset including unamortized amount of deferred revenue expenditure. So in case in the balance sheet of your entity there is an item called unamortized amount of deferred revenue expenditure, Now this is also to be ignored while doing the valuation. And why this is to be ignored? Because unamortized amount of deferred expenditure is nothing but it is a fictitious asset. It is an asset which is only on paper. It has got no real value. And therefore, in the calculation, this amount also will need to be ignored. Now, there are a few posers. Will A, and that is what we have understood, we have discussed, all the assets. So, will all the assets other than B, C, and D in the above formula include intangible assets? And the answer is yes. Answer is yes, because intangible assets, if they are reflecting on the balance sheet of the company, and that means these assets will be part of your part of a component of the formula. Will capital work in progress on account of tangible as well as intangible asset be considered in computation of fair market value? And the answer is yes, because capital work in progress, whether for intangible asset or for intangible asset, it is an asset. It is an asset which is physically there. It may not be complete for the purpose of operations, but it will be part of our formula. Next question is, which balance sheet should be used for the purpose of determination of valuation of unquoted shares? So let's say, for example, your last balance sheet was on 31st March 24, and you have to do the valuation today, and that is you have to do, let's say you have to do the valuation on 1st April 25. So your balance sheet for 31st March 24 is not ready, and today you have to do the valuation. So which balance sheet will you use? Question number 1. Question number 2, your balance sheet, last balance sheet is as of 31st March 24, and you have to do the valuation on 1st July 24. Which balance sheet will you use? Now typically the thought process is people think that you will have to create a balance sheet every time when you have to do the valuation. In my view, it is not necessary. Even if you have to do the valuation of 1st April, even if you have to do the valuation on 1st April 25, the balance sheet that you have with you is 31st March 24. In my view, you can do the valuation based on the 31st March 24 balance sheet. Only thing is what you have to do. You have to make necessary adjustment for the developments that would have taken place from 31st March 24 to 1st April 25, or from 31st March 24 to 1st July 24. That is what you have to do. The bottom line is, it is not necessary that every time when you have to do the valuation of unquoted shares of an unlisted entity or a private limited company, you do not have to prepare the latest balance sheet every time. It is not necessary. You only have to ensure that whatever numbers that you are taking based on the past balance sheet, those numbers are updated, and you have necessary support, preferably a certificate from a chartered accountant with regard to the, or preferably from someone who is income tax registered valuer. That would make your numbers still more stronger. What should be the date of the balance sheet for the purpose of fair market value? It can be the last balance sheet with some necessary changes. Is an audited balance sheet required, or an unaudited balance sheet will do? As I said, an unaudited balance sheet will also serve your purpose. You do not have to have audited balance sheet for the purpose of valuation as per Rule 11UA 1CV. If it is available, it is good. If it is not available, then of course you do not have to. But you only have to ensure that whatever working that you have done, they are as accurate as possible. Now the next question is how to treat brand value of the business not reflecting in the balance sheet. So let's say, for example, there is a company XYZ. This XYZ has been in existence for last 50 years. In last 50 years, company has created a huge brand name for itself. Let's say, for example, you are doing valuation of Joshi Badewale, or you are doing valuation of Chitle Bandhu, or you're doing valuation of any of these companies that we hear of every day and which are not listed. These companies, whether it is Chitle Bandhu or it is Joshi Bade Wale, these companies have created a huge brand value for themselves. And as it stands today, that value, that brand value does not reflect in the balance sheet for the reason that I mentioned to you a little while ago. So the question is, will such brand value will need to be factored in arriving at the value or fair market value of these unquoted share? And the answer is no. If the brand value is not reflecting on the balance sheet, you have to simply ignore and you do not have to worry anything about it. What B is in that formula, we have seen it is jewelry and artistic work. What C is in that formula, we have seen shares and the securities. And what D is in the formula, we have seen it is immovable property. So how will you do the valuation of B? We have seen it, purchase price, or what price it will fetch in the if sold in the open market, or the report from a valuation registered valuer. D is the what will be the value of immovable property. So value of immovable property, if it is reflecting in the balance sheet of this company whose share you are trying to value, so the valuation of immovable property will be done based on the value assessed or assessable by authority of the government for the purpose of payment of stamp duty. The same value you will take as the immovable property. Let's take few more posers. How to value unquoted shares of other unlisted companies appearing in the balance sheet of the unlisted company whose unquoted shares are being valued. So let's say, for example, you are doing the valuation of company XYZ Private Limited. Now, you are doing the valuation of XYZ Private Limited based on Rule 11 UA1CB. Now, the question is, XYZ Private Limited also have another company in the balance sheet appearing as an investment, that is ABC Private Limited. So now the question is, how will you do the valuation of ABC Private Limited? And the answer, of course, is you will do the valuation of ABC Private Limited in the same way as you are doing valuation of XYZ Private Limited. The entity has jewelry and artistic work appearing in its balance sheet, which was bought by the entity 5 years back, for which the invoice from a registered dealer is available. Can the entity consider this price given in the invoice for the valuation of this jewelry and the artistic work? The answer is no. And why the answer is no? Because this jewelry or the artistic work was purchased by 5 years back. Even though you have the invoice with you, but remember that invoice is not of much significance, because in 5 years things would have undergone a change. And therefore, you will not be able to use the 5 years old invoice. You will have to do the valuation of all these items, jewelry, artistic work, etc., using an income tax registered valuer. Now, in that formula that we discussed, A plus B plus C plus D minus L, what does L stands for? So the L stands for book value of liabilities shown in the balance sheet. यानी कि जो आपकी बैलेंस शीट है उस पे जो लाइबिलिटीज हैं, उन लाइबिलिटीज की जो बुक वैल्यू है, बट नॉट इंक्लूडिंग द फॉलोइंग अमाउंट्स, right? So you will pick up all the items of the liability side of the balance sheet, but not picking the following items. Which one? Number one, paid up capital will not be deducted. Number two, amount set apart for payment of dividend on preference shares and equity shares where such dividends have not been declared before the date of transfer. So if there is any such amount which is reflecting in the balance sheet of the company on account of dividend on preference share capital and the equity share capital, and such dividend has not yet been declared in the shareholders meeting, and therefore such provisions will also not be deducted. So that means they will be ignored. Reserves and surplus will also not be deducted. Please remember, reserves and surplus are at the same footing as the equity share capital. You're trying to value the equity share capital. Reserves and surplus are nothing but the capital of the shareholders, and therefore reserves and surplus will also be ignored. Any amount representing provision for taxation. So in case if you have made excess provision of taxation, then such excess provision of taxation will also be ignored. So some more posers. Is preference share capital a deductible liability for the purpose of 11(u)(a)(1)(c)(b)? Answer is yes. How to treat compulsorily convertible preference shares or compulsorily convertible debenture or convertible warrants? So as regards CCPS, it is a liability of the company until the time it is converted into shares. So as of the date of the valuation, if CCPS is appearing as CCPS, then this will be treated as a liability, and it will be treated as a liability, and it will form part of the L component of the formula. Same is the case with the compulsorily convertible debentures. However, as far as the convertible warrants are concerned, they will not be deducted. And why they will not be deducted? Because convertible warrants, please remember, is nothing but a paper, is not a frozen liability. Convertible warrant is only an option which is only on paper as it stands today. So convertible warrant will not reflect in the balance sheet of a company. They will reflect below the balance sheet line, below the balance sheet, and that is why convertible warrants will not be deducted, but preference share capital, CCPS and CCDs will be deducted. How to treat optionally convertible debenture? So optionally convertible debenture on the date of the valuation are a liability, and therefore they also will be forming part of the L component of the formula. Is share premium a deductible liability? Of course not. Share premium, paid up equity share capital, and the reserves and surplus. These three things belong to the shareholders, and that is what you're trying to value, and therefore share premium will also not form part of component L. How to treat other than those set apart towards depreciation? I think is already covered. How to treat asset revaluation reserve if there is any? So asset revaluation reserve, please remember, is to be ignored. And why it is to be ignored? And that is because the valuation of immovable property will be done based on the government authorities' assessment for the purpose of stamp duty, and therefore asset revaluation reserve, while computing value as per rule 11(u)(a)(1)(c)(b), will be ignored. And so this is your further expansion of L component. B is any amount representing provisions made for liabilities other than ascertained liabilities. So in case if in the balance sheet there are certain provisions made for the liabilities which are not ascertained, such provisions will also not form part of L. Amount representing contingent liabilities. Please remember, contingent liabilities are not yet liability coming in the balance sheet of the company, and therefore contingent liabilities will also be ignored. What is PB? Is the paid up value of such equity shares which are to be valued, and what is PE? Total amount of paid up capital, as we have already discussed. So this is how, friends, the valuation under rule 11(u)(a)(1)(c)(b) will be done of the unquoted shares. So please remember, liabilities listed from 1 to 4 are not to be deducted. We have seen this, and the reason is because they are part of the equity shareholders. When to use rule 11(u)(a)(1)(c)(b) for determination of fair market value? So in simple words, you can use rule 11(u)(a)(1)(c)(b) for determination of fair market value of an entity whose net worth is positive. If the entity's net worth is positive, is negative, in that case you will need to check. If you will need to check what? Check if the entity is having jewelry and archaeological objects or painting or any other artistic work. If the valuation of these four components is additionally increasing as much as that is making the company's net worth positive, in that case also rule 11 UA1CB can be used. Can a loss making company be valued based on rule 11 UA1CB? Loss making company can be valued based on rule 11 UA1CB provided the net worth has not become negative. If the net worth has become negative, then rule 11 UA1CB will not work. How to do valuation of a loss making company having negative net worth for determination of fair market value of its unquoted shares? So as I mentioned to you, if it is a loss making company and the net worth has become negative, लेकिन अगर आप उसकी ज्वेलरी की वैल्यू सही करते हैं और उसकी लैंड एंड बिल्डिंग की वैल्यू सही करते हैं और उसकी जो आर्कियोलॉजिकल ऑब्जेक्ट्स हैं उसकी वैल्यू सही करते हैं और उसमें जो इंक्रीज होता है उस इंक्रीज की वजह से अगर कंपनी की एडजस्टेड नेटवर्थ पॉजिटिव हो जाती है तो आप रूल 11 UA1CB को यूज कर सकते हैं. हाउ टू डू वैल्यूएशन ऑफ अनकोटेड शेयर्स ऑफ अ लॉस मेकिंग कंपनी having negative net worth and no potential to turn around. So if the entity has got no potential to turn around, then there is no point in doing the valuation. You should start disposing of the assets of that company and recover whatever you can recover from that company. What are the consequences of rule 11 UA1CB based valuation on the transaction price? Please remember, whenever you are doing valuation, you are only trying to find out a reference rate. So whenever someone does valuation, he is not finding out the transaction price, he is only finding the reference price. So the transaction price can always differ from the valuation arrived at by the entity. Why has the department not included DCF for rule 11 UA1CB? The objective of the...
Sorry for the interruption, sir, but I think Somil wants to ask something.
Okay. Go ahead.
नहीं सर, वही था जो मैंने पूछा था ना, that in case of unquoted shares the valuation is manipulated by the management. So I thought I would be asking you at the
Okay, so let me just finish and then I'll come to your question. Okay. Yeah. Okay, DCM.
One more thing, will you be able to wind it up by 5:30?
Yes, of course. Yes.
We have to do the vote of thanks before that also.
Okay, don't worry. Yeah, we'll, yeah, okay. So why has the department not included? Okay, the reason behind it's not the department has not included. Department has only suggested rule 11 UA1CB for the purpose of valuation. So one can always do the valuation using the discounted cash flow method as well. So long as the valuation as per the discounted cash flow method is coming more than the valuation as per rule 11 UA1CB. Will the indexation benefit available? Indexation benefit is not applicable because indexation benefit is for the purpose of arriving at the deemed cost of an asset, and here what we are trying to find out is the value of the asset. So indexation benefit is not applicable, right? Okay, so I think this we have covered already. So and this also. Okay, now let me take your question quickly.